Good afternoon, everyone, and welcome to our first quarterly review webinar for 2024. Joining us from the tranquil town of Greyton in the Overberg, where only the Hardy-Dars disturb the peace, we have Nick Downing, founder, CEO, and Chief Investment Officer. In the next hour or so, Nick will take us through the following topics. First up, economic and market review, then the market outlook, potential 2020's boom, projected asset class returns, the OAM global portfolios, investment company discounts, the OAM investment positioning, and then we'll end the session with a Q&A session where Nick will answer questions sent in by our clients through their wealth managers. We would love to hear from you, and we encourage you to please send us your questions after the session to info@overberg.biz, and we'll respond as soon as possible. So without any further ado, I now pass you on to Nick Downing.
I'll start again. Thank you very much, Carel, for the introduction. Welcome everyone to this quarterly webinar. We will be having a webinar every quarter. We had the first one in November last year. This is the first one of this year, and we will continue with those as time progresses. Just a bit of housekeeping. I did tell the Hardy-Dars to try and be quiet. They seem to be quite well behaved at the moment. Long may it last. So we'll begin with the economic and market review. The economic expansion continues to defy the doom and gloom predictions of recession that were the consensus view at the end of last year. US GDP grew at a gangbusters rate of 4.9% annualized in the third quarter of last year, and then 3.3%. So in the third quarter, 4.9, 3.3 in Q4. Confidence in the markets was restored in November by lower than expected inflation data, which led to lower bond yields and implied a peak in central bank interest rates. At its December policy meeting, the Federal Reserve Bank of the United States signaled that rate cuts would be forthcoming. So this was the first such signal in the current cycle. It signaled 75 basis points of rate cuts in 2024 and another 100 basis points of rate cuts in 2025. As a consequence, yields fell across the all-important US Treasury bond curve, placing downward pressure on the yields of financial assets around the world. As yields decline, prices rise. There was a strong year-end finish for global equity markets, except of course, despite the reduction in yields at the end of the year, the S&P sovereign bond index still lost 16.5% in dollar terms in 2023, capping the worst two-year performance in 150 years. Thanks to the Magnificent Seven shares, the mega cap tech stocks in the US, which comprise Alphabet, Apple, Microsoft, Amazon, Nvidia, Tesla, and Meta, the global MSCI All Country World Index gained by 17.7% in 2023. So these mega cap tech shares, the Magnificent Seven, have an 18% weighting in the MSCI All Country World Index. The Equal Weighted Index, which has an equal rather than weighted allocation to its constituents, was up by only 2.3% in 2023. So what happened? Let's look at the inflation data. It was really the much better than expected inflation data that emboldened the Federal Reserve to signal interest rate cuts, which led to falling bond yields. Inflation data was impressive. The Personal Consumption Expenditures Index, or PCE, inflation, which is the Federal Reserve's preferred measure, is already approaching the Fed's 2% target. The core rate, excluding more volatile food and energy prices, is very close to the 2% target, both on a 3-month and 6-month annualized basis. I'm going to use this tool just to illustrate that. So you can see the fast decline. The blue line is the 3-month annualized, red line 2-month annualized, the 2% target. It had been as high as 6% in 2021 and for most of 2022, and you can see the sharp decline in that inflation, key inflation measure. Households do not believe the pandemic-driven inflation spike will last. According to the New York Fed's Consumer Expectations Survey, a reliable barometer of nationwide sentiment, inflation expectations are back to pre-pandemic levels. So pre-pandemic, the level was around 2.6% 3 years out. It's back to that level now. The same should happen to wage demands. Meanwhile, the US economy is re-accelerating. There has been a continuation of above-trend economic growth. This is confirmed by solid recent economic data, including a steady and material improvement in the closely watched Dallas Fed's weekly economic index, which provides a signal of the state of the US economy. Strength is being underpinned by strong household and company balance sheets, excess savings, fiscal stimulus. The deleveraging in the decade after the 2008-2009 global financial crisis means the private sector is less sensitive to rising interest rates. In the current earnings season, a record high 87% of companies have exceeded market expectations. What about the economic and market outlook? The 2024 outlook for equity markets and financial assets is encouraging. Inflation is the single most important variable in the current market cycle due to its massive post-COVID surge and the disruption of low interest rates. The faster that inflation comes down, the greater the chances of an economic soft landing. Falling rent inflation will drag down overall inflation. Rising labour productivity will increase will reduce wage cost pressure. We will see the start of interest rate cuts led by the Federal Reserve and followed by the ECB and the Bank of England. Recession risk is low. At worst, it will be brief and short-lived. There is only a 50% chance of recession in the US, ergo a 50% chance of a soft landing. A soft landing is an economy that slows enough for unemployment to rise and inflation to decline, but without tipping into recession. In Europe and the UK, we will probably enter a recession in 2024, but in the absence of structural imbalances, those recessions are likely to be mild and short-lived. China, meanwhile, should achieve targeted growth of 5%. Bonds, after their worst two-year period in 150 years, are once again offering attractive yields. Robust equity market gains can be expected again, or maybe not again, but certainly since November we've had strong markets, and we're expecting that trend to continue into 2024 and 2025. Led by the US in the falling inflation and monetary easing queue, and a bubble may well develop in AI-related stocks. So let's look at inflation. This is the key conundrum. Inflation stemming from the cost of rent remains a key driver of still elevated overall inflation in the US. But the current trend in new rental agreements points to an imminent sharp drop in inflation. The rental index leads rental inflation by a few months and signals that rental inflation could drop to 2% by mid-year from 6% currently. So here we've got rental index. Those are actual rental agreements signed by tenants and landlords. And there's a lag of a few months. You can see the blue line measures CPI rent, currently at 6%, and that will fall all the way to 2%. On a 3-month and 12-month annualized basis, core US CPI, which excludes shelter, is already at 1.5% and 2.1% respectively. As the shelter component of CPI lags the sharp decline in the housing and rental markets, a significant inflation decline is in prospect. Shelter inflation accounts for 44% of core CPI and 18% of core PCE inflation. Skeptics believe that tight labour markets will prevent inflation returning to central bank targets, especially in the more buoyant services or non-manufacturing sector of the economy. Yet, if we look at the forward-looking ISM Purchasing Managers Survey, shown in the graph here, it shows a sharp decline in the employment index, indicating easing wage pressures in the services sector. You can see the decline. Meanwhile, productivity is rebounding. Labour productivity has risen to 2.4% from a dramatic low of -2.4% during the pandemic in the US. Artificial intelligence will likely entrench these productivity gains. By way of example, in the 1990s, the internet revolution accelerated productivity growth from 1% to 3.5% 10 years later in the early 2000s. AI applications could well do the same thing. Productivity spells lower inflation. Increased labour productivity means that the inflation residuals, by that we mean wage growth minus productivity growth. If we look at wage growth of 4.1% or thereabouts, and productivity growth of 2.4%, it means that the inflation residual has been falling sharply. According to the latest data that is available, the inflation residual has already fallen to 1.4%, in line with pre-pandemic levels. If sustained, productivity growth will push inflation incrementally lower. So we can see core PCE inflation just below 4% now, or call it 3% in this graph. The inflation residual, it shows back to pre-pandemic levels. And then still on the inflation theme, before we move on to the next slide, it may have failed some people's notice that China is in deflation at the moment, showing negative CPI and PPI figures. And China is exporting deflation globally. Its export prices are currently falling at a year-on-year rate of 10%. The Fed is poised for interest rate cuts, and this is one of my favorite graphs. Soaring inflation. So we can see soaring inflation 2021, 2022 led the Federal Reserve to embark on its most dramatic cycle of interest rate hikes since the 1970s. Inflation has already begun dropping, almost a symmetrical curve, falling as sharply as it increased. Does this mean that the Fed could also cut interest rates just as rapidly? It probably will. The ECB and the BOE, the European Commercial Bank and the Bank of England, will follow. The end of quantitative tightening will add to the pace of monetary easing. The coming changes to US monetary policy will not only be on interest rates, it will also include an increase of the Federal Reserve's balance sheet, which will create an expansion in global liquidity. Global liquidity is crucial to keeping financial assets buoyant. The Federal Reserve has the capacity to ease policy. The coming growth slowdown shouldn't develop into a severe recession. One of the key reasons for this is that the Fed has a lot of room to ease monetary policy. The Federal Reserve has substantial capacity for interest rate cuts. The Fed funds rate, currently at 5.5%, is substantially above the estimated equilibrium real interest rate, which is defined as the rate which neither restricts nor stimulates economic growth. The real Fed funds rate, currently hovering just below 4%, the equilibrium rate, an estimated level of around 1%, which means the Federal Reserve could cut its interest rates by over 300 basis points before getting to equilibrium level. Meanwhile, household balance sheets are healthy enough to withstand a period of rising unemployment and income erosion. The decade of deleveraging that followed the global financial crisis, on top of the massive pandemic-era handouts, have restored household balance sheets to rude health, lowering the risk of recession. So if we look at this graph, stems back to the global financial crisis, we can see a huge, almost parabolic increase in the net worth of US households. Total assets minus liabilities have almost doubled over the last 15 years. Debt as a percentage of disposable income has come all the way down from 150% below 100%. And banks are well capitalized. They are healthy enough to withstand some deleveraging. The financial system has been repaired since the global financial crisis. US banks have strong capital buffers which mitigate the risk and severity of any recession. So we can see the capital adequacy ratio of Tier 1 on a Tier 1 bank measure going from 10% to 14% over the period following the global financial crisis. There is the potential for a 2020s boom. There are very strong similarities between the 2020s and the 1920s. Is the 2020 pandemic crisis the much needed catalyst to push the US economy out of its long trend of declining productivity and income growth? If we look at the similarities, the 1920s were preceded by World War I, the 1918 Spanish flu, the 1920-1921 recession. You can see how I'm getting caught up. The two are so similar, I'm getting them mixed up. 2020s began with a COVID-19 recession, which was sparked off by the pandemic and then the Ukraine war. In the 1920s, we had game-changing new technologies and innovations that followed that dark inflationary period. Electricity, the automobile, telephone, radio, assembly lines. The pandemic in 2020, the COVID pandemic, has also sparked rapid and long-lasting economic, social, and technological changes. AI has reached an important threshold where its application will begin to proliferate at an accelerating pace. We have work from home, which is here for good. Household debt levels are the lightest in 2020 in 22 years. The economy is no longer facing deleveraging pressure and is positioned for a brand new credit cycle. Let's look at a couple of graphs. So the early 1920s versus now, it's striking the similarity. The inflation trajectory from 1911 to 1920 and from 2024 to from 2014 to 2020 are remarkably similar. The roaring 1920s was preceded by supply destruction and soaring inflation. World War I, the Spanish flu. Technological innovations drove down inflation, stimulated growth, and created economic prosperity. The 2020s post-pandemic recovery has also been preceded by severe supply side disruptions and surging inflation. So let's look at the long wave productivity growth charts. Productivity growth goes through long waves. Wars or major crises are often inflection points, serving as catalysts for change. The 2020 pandemic, which saw long-lasting social, economic, and technological changes, huge fiscal spending, work from home, and accelerating adoption of AI, may pave the way for a productivity rebound. This is where our productivity is currently. You can see it has a potential to do what happened during the 1990s with the advent of the internet. So where you can see the red spot, 1990, the dot-com bubble burst, 2001, then a long period of deleveraging. Private sector balance sheets amended, ready for another credit cycle. We have a new technology. It's a very likely that productivity will follow this long wave pattern that we've had since 1960. Rising productivity will bolster economic growth while bringing down inflation. Projected asset class returns are very bullish. These are Capital Economics independent research company. Their very latest forecast from the 19th of January, I believe, between now and the end of 2025. Developed market and US Treasury bonds have performed poorly over the past 10 years, with annualized dollar returns of minus 1.3% for developed market bonds, and for US Treasury bonds plus 0.7% respectively. But following the terrible 2 years that we've had, they are now once again attractively valued. And that's why between now and the end of 2025, we're expecting decent returns from developed market government bonds, US Treasuries, European government bonds, investment grade corporates, and high yield corporates. Falling inflation and interest rates, combined with robust economies, should ensure solid equity market gains over the next 2 years. And we've got global 38.4%. These are all dollar-based. US 39, Europe developed markets 39, UK 43, and so on and so forth. You can read that chart. Moving on to OAM global portfolios. We will look first at the global balance portfolio. At the end of December 2023, the global balance portfolios comprised the following asset allocation and geographical weightings. On the right-hand side. I won't run through all of them individually. This presentation will be emailed to all of you and to anyone who requests it after the presentation is over. Equity exposure has since been increased, allocated to the US market. And this is the long-term performance chart since inception, going back to 2002. So we've got a 21-year track record. The long-term performance chart shows some ups and downs, which one would expect, similar to the global economic and market cycle. But the trend you can see since November last year, with improving inflation and interest rates, figures, the trend is once again rising after a couple of difficult years. As Warren Buffett's business partner Charlie Munger wisely said, the big money is not in the buying and the selling, but in the waiting. Those of you who have waited over the past 2 years will be rewarded for your patience. The global growth portfolio, quite similar, but with a greater equity exposure, a greater exposure to private equity, which has very similar risk characteristics to equities. Here we show the global growth portfolio, asset allocation and geographic weightings at the end of December 2023. And here too, the equity exposure has since been increased. So it'll be not 52.84%, but somewhere around 56.84%. Again to the US, at the end of December, 39.13%. It'll now be more like 44%. We can see a similar recovery since November last year, the time of our last webinar. The recovery is expected to continue for the next couple of years for the reasons given, more or less in line with the forecasts shown earlier. Our portfolios are invested in investment companies, closed-end funds listed on the London Stock Exchange. They trade as shares, they are shares, and therefore they tend to trade not at net asset value like unit trusts do, but around net asset value. They can trade at a premium or a discount to net asset value. In 2023, NAV discounts reached their widest since the global financial crisis in 2008-09 as a perfect storm of rising interest rates, bond yields, economic uncertainty, and geopolitical conflict weighed on sentiment. Net asset value discounts widen during periods of uncertainty. They narrow during recovery periods, providing a double whammy to investment portfolios. NAV discounts have narrowed from the extreme levels in 2023, as you can see here, but they still remain wide by historical standards. So if we look at the levels before COVID, after COVID, and then surging inflation, interest rates, and then bumbling, hovering around these low, extreme wide levels, we've now seen the beginning of a narrowing in NAV discounts. So this goes all the way back to 2019, January. Let's have a look at a longer term chart going back to 1990. So there's quite a bit of fluctuation. You can see that discounts vary anywhere between, in the worst case, 20%. At the height of the credit crunch, global financial crisis, 08-09, we had a 25% discount across the 300 or so investment companies. In the good times, we have premium. There was a premium in the dot-com bubble. Maybe we'll get another one with AI and the productivity boom and lower inflation, lower interest rates that we're expecting. So this chart goes back to 1990. We've seen discounts beginning to narrow, but clearly there is much further to go as inflation declines and central banks begin cutting interest rates and a new economic and investment cycle unfolds. OAM's investment positioning, a critical transition from disinflation to policy reflation, will likely be the major macroeconomic theme for 2024. We are bullish on equity markets globally. Ongoing disinflation pushing interest rates lower will overpower the risk to earnings from slower GDP growth. NAV discounts have narrowed from extreme levels, but remain wide. There are high-quality management teams and underlying assets available at bargain prices. A couple of examples: Rothschild Capital Partners, the investment vehicle for the Rothschild family, trades currently at a 21% discount to net asset value. Over the last 40 years that it's been listed, most of the time it trades at a premium. Scottish Mortgage, most of the time it's been trading at a premium to net asset value as high as 11%. In October, November last year, the discount was 20%. It's already begun narrowing, but it's currently at a discount to NAV of 11.5%. There is still a lot of potential for narrowing for such a blue chip investment company. Recent trades at Overberg Asset Management reflect our growing conviction in the technology sector, which happens to be our largest portfolio holding. We also have strong conviction in US equity markets. The US should materially outperform, maintaining its pole position based on its AI, artificial intelligence dominance, and being the first to see inflation returning to target and to see falling interest rates. A bubble may well develop in AI-related shares, which could continue into 2026. Parallels have been drawn with the productivity boom of the 1920s. We have a growing conviction in technology shares, which we expect will be the main beneficiaries of development and expenditure in AI. Cash holdings have been allocated to short-dated 1 to 3 year US Treasury bonds. They were bought at the recent bond yield peak in November 2023. Cash resources, especially in the growth portfolios, to some extent in the balanced portfolios, and much less so in the defensive portfolios, will be incrementally put to work as the bull market unfolds. Meanwhile, bond markets, for the first time in many years, are now offering attractive yields, helping to provide greater stability to the performance of diversified portfolios. So now we move on to the Q&A segment. I think Carel's going to chip in at this point.
Yes, thanks, Nick. Thank you very much for that update. I think there's a lot to look forward to in 2024. So putting you in the hot seat, we've got some questions that we got from our clients. So first question, and you've spoken quite a bit about interest rates in this session. The global markets have been fixated on interest rates in the last 2 years. It's widely believed that we are currently at peak rates in most of the developed countries. When do you expect global interest rates to start easing?
Yeah, thanks, Carel. Well, the Fed will have its next policy meeting tomorrow. In December, they signaled that they would be cutting interest rates in 2024 by 75 basis points and 100 basis points the following year in 2025. The risk is that the Fed is overly cautious. So they were caught out by the surge in inflation in 2021. Many will recall that Jay Powell, the governor of, or the chair of the Fed, said that don't worry about it, inflation's just transitory, it'll come down very quickly, and they're caught unawares. And I think there's a fear in the market that because of that, they don't want to make the same mistake twice. So they will err on the side of caution. Some economists, analysts believe that we could get a rate cut as soon as April. We don't believe that to be the case. We think it'll probably be sometime in June. So the Federal Reserve will be first, and then hot on their heels will be the ECB, the Bank of England. Japan, meanwhile, is increasing interest rates, and China has already begun cutting interest rates, but we feel that the urgency of their rate cuts will accelerate.
Thanks, Nick. Talking about China, I think the Chinese market has disappointed since the end of the COVID pandemic. What's your view on the Chinese market?
Well, China's equity market is at record cheap levels. It's trading at a 40% discount to the emerging market index, whereas traditionally it trades at a premium because of its historic strong growth. The chief culprits are the collapsing residential property market, but also the leadership's erratic and interfering approach towards the private sector, and of course the geopolitical risk between China and the West. The most pessimistic analysts believe that China is uninvestable, and they cite the example of Russia. We know what happened to the Russian stock market after the country invaded the Ukraine. The Russian stock market basically fell to zero and became completely uninvestable. So in the worst case scenario, if China invades Taiwan, many investors around the world are fearful that the same thing could happen. We don't believe that's at all likely, and we also feel that China's economy and stock market is too large, too important to ignore.
Thank you, Nick. So we had a quick look at the geographical allocations across the balance and the growth portfolio. And you spoke briefly about changes we've already made during this year. Is that likely to change much in 2024, the geographical allocations?
No, specifically on the geographical allocations, the biggest holding is currently in the US. We've been raising the US weighting steadily since the end of 2022, and it's still rising. Over the last week, we've been increasing exposure to the US, and we may well continue to do that over the course of 2024. However, the investment strategy at OAM is to divide our exposure half between growth investments and the other half with value investments. So there are some very distressed valuations, deep value investments out there available today. For instance, as I mentioned earlier, Rothschild Capital Partners that has significant exposure to Latin America, the Far East, to Japan. I mentioned also China trading at distressed levels, and we would be looking potentially at increasing exposure to China at some stage during the course of this year if there's an indication from the leadership that they are doing what is needed to reflate their economy.
And Nick, I hear you briefly touching on growth and value investments. I think that's always a good debate at the start of the year. So growth versus value in 2024, what's your view?
Well, this is it's a very difficult question to answer. Growth investments tend to outperform when interest rates are low and coming down, as the earnings of growth companies are very long duration, often based on new technologies that may take many years to become profitable. So when we value long duration earning streams with the discount factor that is guided by US Treasury bond yields and other interest rates, then they become much more sensitive or vulnerable to changes in interest rates than typical established value companies. So if interest rates do fall rapidly, as we're expecting, then that would benefit growth shares. I would say also that we have a strong conviction towards technology because of the advent of AI. So technology shares are predominantly growth oriented, and for that reason, if we had to put a wager on it, we would prefer to put it on growth investments.
And Nick, the next two questions relate to holdings in our portfolios. I think there's been some concern from clients about these two holdings. So I might pose these in one question and you can answer one after the other. So the first one is the NB Global Floating Rate Income Fund that has been underperforming. And then the second one is the Hypnosis Songs Fund. If you can maybe elaborate on those two.
Yes, certainly. I'm glad that we have had the opportunity to address this. We've had a lot of questions from our clients, according to the wealth managers. So NB Global Floating Rate Income Fund Limited is currently trading at a very low value in clients' portfolios compared to the entry level. But the reason for that is because the company has implemented 5 capital distributions. So on the 27th of January 2023, the company announced that it would be going into managed wind down, selling its assets and distributing the capital value. The good news for investors, for our clients, is that the share trades at a 12-13% discount to NAV, net asset value, but the assets are being realized at around NAV, sometimes at a premium, and being distributed as they arrive. So shareholders have actually done incredibly well. Quite often investment companies get acquired or merged or go through a managed wind down, and this is normally a very bullish thing for shareholders, adding a lot of value. It's something that could happen to Hypnosis Songs Fund, By way of introduction, Hypnosis Songs Fund shares in the royalties of music catalogues, royalties that are bought from music producers, recorders, writers, performers. They own thousands of different royalty streams. So in the last year, the company has been through a very public spat between the board of directors, the management team, and the shareholders. And it came to a boiling point when the management team tried to sell some of its catalogues to a related party. And that, of course, raised all sorts of conflict of interest questions. As a result, the board was fired, and a new board has come in tasked with coming up with a new direction for the company. It could either involve the sale of catalogues, agreeing to be acquired by another company, or the managed wind down, very similar to the specialized credit company NB floating rate, which we discussed, which will be selling the music catalogues at NAV. So the music catalogues themselves are incredibly high quality. The underlying revenue streams are increasing year on year at a rate of 10%, which is incredibly good. So we are very bullish on the outlook for the share. The share trades at a 50% discount to net asset value. So if they wind up, then that could potentially mean a very large increase in the value of the shares. There is still some risk. There's a lot of negative sentiment. The share has performed poorly. We're disappointed by that, but the outlook is good, and the share price only constitutes around a 2% weighting in client portfolios.
Well, thank you very much for that. And that brings us to the end of the webinar. I would just like to thank everybody for joining us today. Nick, thanks for preparing this webinar, and also everyone, the team at Overberg, that made this session possible. I just want to remind you, if you have any questions for us, please email to info@overberg.biz, and we will try and get back to you as soon as possible. I hope everybody enjoyed it, and have a good day, and we'll speak soon. Thank you.